Good morning and welcome to the show, and we're looking ahead certainly to the reopen of markets here in Hong Kong. You're the dragon, enter the dragon, of course. Welcome to Bloomberg Markets China Open. I'm David Ingles. Let's get to your top stories today. Stocks across the region, including what's happening in fixed income, hits straight in the chin. Hotter than expected U.S. inflation numbers causing that the price action you see on your screens. Japan's top currency chief is issuing warnings after the yen, as you can see, has weakened through that key 150 handle. Now, MCI dropping dozens of Chinese companies from its global benchmarks, adding to risks for the country's beaten down equity markets.
I'm Haslinda Amin in Jakarta, where 200 million voters are choosing a new president and government, with investors looking for signs of policy continuity as the Jokowi era comes to an end.
Yeah, there we go. So certainly Indonesia is one market that isn't trading today because of elections there. At Haslinda is, of course, our in-depth coverage. We'll get you to that periodically, of course, over the next few hours or so. And certainly, I guess it just highlights the fact that geopolitical risk, political changes, and it takes us into Pakistan as well, front and center across these markets, on top of an issue which has really come back front and center quite quickly and swiftly, inflation numbers coming through out of the U.S., reminding investors that it's not so much a year of, I guess in many ways we knew this already, a year of elections coming through. Inflation has not gone away. At least that last mile certainly has proved to be quite sticky and difficult with that very hot inflation print out of the U.S. overnight. And as you can see, markets are reeling with equity markets. This part of the world, the markets that are up and running right now, feeling the pinch from that inflation report. You have the Kospi index, which is, of course, growth and tech heavy. We're looking at, of course, mainland markets still shut, so Hong Kong reopens today, and certainly goes without saying, some of the growth and tech-related names will be very much in focus here. Currency markets, a very strong dollar, 6 weeks and running, massive move up overnight. In fact, it was to the extent that we had Japanese officials right before markets opened in Tokyo today coming out with fairly strong language around how they're closely watching this. You have the FX, the Ministry of Finance, in close coordination with the Bank of Japan, issuing quite a strongly, I guess in many ways, worded early verbal intervention there as far as things go. Dollar up, yields up, as you can see on your screens. Yields continue to move up across various parts of the yield curve as well, 5 all the way down to 30-year. The 2-year yield, of course, pulling back after what was just a massive, massive move up in terms of the yield and price down, obviously, overnight. Oil, despite, of course, the pullback we're seeing today, we're still trading near those 2-week highs. That being said, of course, we get above that, and it takes us back to levels that we saw late last year. And, of course, Bitcoin also very much in focus following, of course, that move around 50,000 level that we had, of course, the last few days or so. But make no doubt about it, this is a risk asset. It has certainly traded like a risk asset, and certainly the conditions out there across these markets this Wednesday morning are not as conducive to that group of risk and assets, of course, as we approach the reopen here in Hong Kong, 26 minutes away. Now, back to the Fed conversation. What happened? What showed? Hot inflation print just about across the board on different metrics. So March has effectively been priced out. May is interesting because when it comes to May, that went from about a 76% probability down to about a third, and now the full rate hike is now being priced for July and even more, and that's getting pushed out even when you look at a full rate hike. In fact, we'll show you another board on the Fed a bit later on that actually shows you May and also July. Let's bring in Mary and Nicola out of our MLive team to talk us through this. Mary, just your broad take. It seems, given the price action, that markets were not prepared for an inflation print that hot out of the U.S.
Very indicative of how the markets have responded, especially because forecasts were showing that, and the Bloomberg consensus was showing that we could actually dip below 3% on the inflation, on the CPI number. So obviously it came in hotter than expected, and we were put into this understanding. The markets had this feeling that things were the economy was hot in all the right places and cold in all in the right places as well. So it was almost opening the door for this perfect scenario where the Fed can start cutting rates, especially as inflation continues to fall. This puts a spinner into everything in terms of saying how does the Fed even consider cutting now that the market is pushing out to July? And of course, if we continue to get some of these hot numbers, it's going to even push it out even further, and the Fed is going to just keep highlighting its focus on caution and its need to see more. Granted, this was 1 month of data, but of course we had the earnings, average hourly earnings. They were much higher than expected as well, and they were showing that earnings are still high. So overall, inflation looks to be a little bit sticky, especially in that last bit, which we knew was coming, but it's proving to be a lot stickier than what was expected.
Right. So as we look at this Hong Kong reopen today, there's also news on MSCI. Effectively cutting just dozens of Chinese stocks from their global benchmark. Certainly you have twin tail headwinds today for this Hong Kong reopen.
Yeah, and that's the thing. It's going to be not just for Hong Kong, but it's going to be for Asian markets more broadly. So, for example, if we see the CPI numbers and just the fact that the Fed rate cuts are being pushed further out, we're not going to be enjoying this everything rally that we saw towards the end of 2023. There's no revival of that everything rally for now, and that's been delayed. So, of course, now you've got these companies removed from MSCI. From these Chinese companies. So it is a double headwind. And obviously, we're going to continue to see them struggle. But there has been a combination for Hong Kong. It's not only the strength of the U.S. economy, but also the weakness of the Chinese economy that's weighing on the equity markets. And that's not going away anytime soon.
Mary Nicola, thank you so much out of Singapore for us, our analyst strategist. Now let's talk about the growth outlook, and certainly inflation continues to remain a fairly fluid concept, and to what extent this inflation continues, and whether or not 1 month of data, as Mary was pointing out, was a blip, or is that a reminder that this last mile down is not going to be smooth and easy for markets, and markets that are hoping as well. The IMF has in fact raised its global and developing economies growth forecast for 2024. Joining us now out of DC, in fact, is Krishna Srinivasan, Asian Pacific Department Director at the IMF. Krishna, thank you so much for joining us, and good morning from the Asia Pacific. I'm looking at your report right now. Before we get into the details of this, why don't you give us the key takeaways? What is the truncated press release version of this report, sir?
So for Asia Pacific, we have revised the growth outlook for 2023. The growth forecast for 2023 to 4.8%, and also for 2024 to 4.5%. And then slowly moderating to 4.2% in 2025. A lot of this revision is explained by better than expected growth in China and India. Again, David, you had to see that this is relative to what we had in our October World Economic Outlook. So China and India account for most of the revision, and Asia Pacific accounts for 2/3 of global growth. Now, in the case of China, you had increased disaster reconstruction spending along with spending for resilience. And in India, you had strong domestic demand. So these two economies put together explain most of the revision we have for Asia.
Right. Just a little bit maybe on China, because to your point, it's China and India as well. From the time that you guys looked at these numbers, and certainly we had the latest growth print as well, would you say risks are balanced right now as far as the outlook for China is concerned?
So for David, for China, we know the growth in 2023 came at 5.2%, and for 2024 we have it at 4.6%. Now, again, in the case of China, we have highlighted the fact that risks are to the downside, and a lot of it emanates from what's happening in the property sector. Again, this is related both to how the property sector bears upon demand, and also it causes stresses in local government finances. So there's kind of there's a cycle there between what's happening in the property sector and what's happening in local government finances. So definitely, the property sector is a key downside risk in the case of China, and we have highlighted what needs to be done. I can get into that if you want.
Yeah, please go ahead, sir.
Yeah. So basically, the Chinese authorities have made a conscious decision to move the real estate sector, which accounted for about 20% of value added, to a smaller and more sustainable scale. And so it's not clear how long the downturn will last in terms of, there's a lot of uncertainty there. And what we have advocated is basically a four-pronged approach to address the problem in the property sector. One is to accelerate the exit of non-viable developers, and you have quite a few of those. Second, you also need additional central government funding for completion of housing. And we have put out a number of 5% of GDP, which is needed in terms of central government support. We also need support for viable developers to refurbish their balance sheet, given the fact that you're going to go into a smaller market. And finally, you need to reform the pre-sale model, which exists in China, and allow a larger role for price adjustment in the market. So I think this four-pronged strategy is needed to resolve the problem in the housing sector in a more durable way. And so far, what we have seen is more of measures to address the housing sector, but not in a very comprehensive way. So I think what we need is a more comprehensive solution to the problem.
And your sense of whether authorities are open to those proposals, of course, because a lot of what you just mentioned don't seem to be easy fixes. In other words, these are structural issues that will need years to put in place, if any.
I think some of these things can be done in terms of how you triage developers, right, between the viable one and non-viable ones. Once you truncate that, then you can estimate how much support is needed to support the viable developers. And I think that's important. I think the triaging is very important. And you do need central government support. Without central government support, it would be very hard to fix the problem. So I think it's a package of measures. Just one or two of these will not do it. So that's why we're emphasizing the fact that you need a comprehensive approach to addressing the sector, the problems of the sector, because this is the key headwind for the Chinese economy at this point in time. And of course, there are long-term concerns in China, but for us, in the short term, this risk needs to be addressed head-on.
Right, and a corner of this financial market is in many ways, I guess, doubting whether or not the toolkit of authorities is a perfect fit or is a good fit for the current set of challenges, including, as you would imagine, boosting consumer confidence is not so much printing a GDP number. In other words, it's not so much a spending issue. And I'm wondering what your thoughts are, whether or not some of these concerns that markets have over China's ability to boost the current economy, whether or not those are merited at this point in time.
See, I think if you talk in terms of confidence, Chinese consumers invest a lot in the housing market. So if the housing market is going to be in a perpetual downturn, which is what we're seeing for the last 2 years, that's not going to really help boost confidence. So if you want to boost confidence, if you want to boost demand, you have to resolve the housing sector. Now, going beyond that, China, we have also lowered our long-term forecasts or medium-term growth forecast for China to 3.5%. So beyond the near term, you have bigger problems like addressing productivity falling, population aging, and so on and so forth. But at this point in time, I think it's important that everyone focuses on addressing the property sector, because that has a bearing on confidence, which has a bearing on demand, and so on and so forth.
Krishna, just very quickly to India, just your thoughts on the outlook there, because that's a big part of the revision this year.
I think India is doing well in terms of, we have growth in 2023 at 6.7%, and in 2024 and 2025, 6.5%. A lot of things, the macro fundamentals look pretty good. Inflation is coming down. It's still not yet a target, but it's coming down. Fiscal is in good shape. So the macro fundamentals in India are very good. They've also done some structural reform measures, including on the digital public infrastructure side, physical infrastructure, and so on. But like in China, there are long-term reforms which are needed in terms of addressing in the land reforms, labor reforms, ease of doing business, and so on. But that said, given where you are today, India is doing very well in terms of growth, and the prospects look pretty good.
The outlook on inflation, and this is a fairly broad question, is the U.S. print that we got overnight, where you are, and certainly you could maybe give us some anecdotal evidence whether inflation is coming down as well. I mean, should we have these expectations that it's going to be smooth sailing all the way down to target this year on this disinflation trend globally?
David, that's a very good question. So if you look at Asia, I mean, there are a couple of things that differentiate Asia from the rest of the world. Inflation around the globe started going up in 2020. When it started rising, inflation in Asia didn't rise so much, right? And so it wasn't as elevated as in other parts of the world. And it started coming at a faster clip. So we have inflation in Asia coming down to target in 2024. Of course, all this depends, there are always, upside risks to inflation. And as you've seen today, what happened in the US. So it's only 1 month, but still it came out, worse than what was expected. So in the case of Asia too, you could have volatility, say, in commodity and price markets. And in fact, food price volatility is a big issue in Asia. So that, again, has a bearing on headline inflation. So again, I don't think it's going to be a smooth the way you would want it. There are going to be bumps, but we think inflation in Asia will come down to target across most countries by the end of the year.
Krishna, we didn't get to talk about Indonesia. We can do that the next time. Krishna Srinivasan, thank you so much for your time, sir. Asia Pacific and the Pacific Department Director at the IMF, joining us there out of Washington, D.C. Now, speaking of Indonesia, coming up, we'll be live out of Jakarta there as the country heads to the polls and vote for their next government and their next president. We'll be speaking with the former finance minister, Chatib Basri, on what this new government and administration will mean for the economy. Also counting down to the reopen of trade here in Hong Kong, just under 14 minutes away. And you're looking at live pictures out of the Hong Kong Exchange as the year of the dragon cometh. This is Bloomberg. Good morning. We'll take you straight back to Indonesia, where the country is headed to the polling stations there to elect their new leadership. In fact, on the ground right now is our chief international correspondent for Southeast Asia, Haslinda Amin, is there live. Has, with your next guest.
Well, Dave, this election is being set against a backdrop of resilient economic growth. We've seen 5% growth for Indonesia. We've seen strong FDI flows. In fact, $50 billion last year alone, a quarter of which went to its base metals industry, that nickel downstreaming. But they say it is not enough. We need to see greater growth in Indonesia to create more jobs, to ensure it does not fall into this middle-income trap. Let's get perspective. Muhammad Chatib Basri, the Bank Mandiri chairman and former Indonesian finance minister. Pak Chatib, good to have you with us. We talk about how the next president needs to accelerate Indonesia's growth. Will it get there?
Well, our problem now, we need to accelerate economic growth to 6 to 7%, because by 2050, Indonesia will start to enter aging population. If we continue to grow by 5%, there is a risk for us to grow old without becoming rich. The challenge is, in order to grow by 6 to 7%, we need investment over GDP between 41 to 48%. And our gross domestic savings now is only about 37. So there is a saving investment gap. So the solution is, whoever become a president, they need to increase the savings. It means that increase the tax ratio to GDP. They need to be open to the foreign investor, and they need to improve the productivity.
Why are we talking about 7-8% growth? Why aren't we talking about double-digit growth for a country, for an economy the size of Indonesia?
Well, if possible, certainly I would be very happy to have this double-digit growth. But looking based on Indonesian history, the highest performance was during the Suharto era, was around 7 to 8%. So looking from the realistic perspective, we can grow by 7 to 8%. Indonesia could avoid the middle income.
What policies need to change?
I think we need to go beyond macro stability. So far, we have this very good macro stability for an anchor. But I believe that one way to do it is to focus on the industrialization, export-oriented, this will bring the economy to the next stage of development.
Also, the tax regime needs to change. I mean, you have to start taxing the rich in a bigger way. Your tax to GDP ratio will need to rise higher than what it currently is right now.
Couldn't agree more, because if you look at our tax ratio to GDP now is only 9%. It's pretty low. And we definitely need to increase the tax ratio to GDP, because the way I look at it, every country, especially the emerging developing economies, they need to expand the government spending due to the scarring effect of the pandemic, due to the health issue, for the issue of climate. And we don't have the luxury to choose between social protection and infrastructure. So we need to mobilize the tax revenue. And one way to do it, the government can do it without raising the tax rate, by reducing the tax exemption, by doing the administrative reform in the tax office.
Why has Jokowi been unable to do that?
Because maybe the way the current administration look at it, they would like to attract the foreign investment or the many investors by providing so many tax incentive and exemption. But I think now if you look at the tax incentive to GDP is around 1.6%, but not much impact in growth. I think it's about time for the government to review again whether this tax incentive is effective or not. And then the government need to improve the quality of spending as well. We spend so many, bigger percentage of our budget for the fuel subsidy. We just only give the benefit for the middle and upper income group.
So the budget deficit needs to be expanded for the spending that you're looking at.
Well, the way I look at it, we have to maintain, of course, the fiscal sustainability. But if we want to somehow to finance the infrastructure, social protection, we definitely need to increase the tax revenue, and you can increase the budget deficit a little bit. Last year, we had a budget deficit is only 1.6%. It's pretty low. Yeah, so there is a room for the government. But of course, we need to anchor the macro stability.
I also want to take a look at the monetary policy. We've seen how Bank Indonesia worked hand in hand with the finance ministry for Indonesia to overcome the challenges, especially during the pandemic. Do you see any immediate changes coming up in terms of monetary or even fiscal policy?
I would say that, for the economic, for the macro policy that's been doing, Indonesia is an excellent. Both fiscal and monetary policy, they've done very well. And that's the reasons why Indonesia was able to survive the pandemic COVID-19 pretty well. We only have this contraction for about 2.1%. It's probably one of the best performer in the world.
And the independence of Bank Indonesia can be maintained, because I remember in the early years of Joko Widodo, he pressured Bank Indonesia to keep rates down.
But eventually, we realized that it is important to keep the Bank Indonesia become independent.
In terms of the rupiah, it's been pretty stable now because of the stronger dollar that is under some pressure. Where do you see the rupiah by perhaps year-end or even in the next 2 to 3 years?
Well, of course, if anyone can make a prediction about rupiah, can be wrong anyway. But if you look at, if you make a comparison, with some other countries, I think the depreciation of the rupiah is pretty low compared to many countries. So I would say that rupiah is pretty much stable, in the last 5 years. So I would say that in terms of this macro performance, both fiscal and monetary, has been able to provide a stability, for the investors.
Pak Khatib, thank you so much for your time. Muhammad Khatib Basri, former Indonesian Finance Minister. Dave, we continue to monitor developments here as Indonesia heads to the polls. 200 million voters set to cast their votes.
Yep. Logistical challenge, to say the least, and then we can talk about implications. Haslinda Amin will be live throughout the morning for us there in Jakarta. But I mean, certainly just for context, right? So, the two markets that keep coming up where analysts remain steadfast and bullish are in the Asia Pacific, at least, Indonesia and India. India holds elections in a few weeks, and of course Indonesia front and center as well. And are those calls and the bullishness around the economies and markets agnostic of certainly who takes the helm there? Certainly part of the conversation we'll be having today as we approach this reopen here in Hong Kong. Also, by the way, against a backdrop of still hotter than expected CPI, yields pushing higher, stronger dollar, and not really the best start, as you can see on your screens, going into this reopen year. The Dragon first trading session with dollar China now trading back above that 100-day moving average for the first time in months. In fact, that's one of the things we're tracking very closely across this agenda here today. Standard Chartered, of course, we'll talk more about this Bloomberg scoop, perhaps some changes in the offing as it pertains to the corporate and investment banking unit there, the reopen, plus, of course, some of the reaction to some of the changes that MCI announced for their benchmarks. That and more are ahead, and the reopen. This is Bloomberg. Okay, happy Wednesday, and yeah, that's what a long weekend does, doesn't it? It fast forwards us to Hump Day, which seems to suggest, and you're looking at live pictures there of Guccio Aguzin here, CEO of the HKX, ahead of the reopen first day of the Year of the Dragon here, against the backdrop of this melt-up in yields, a dollar that's been rallying for 6 weeks, and certainly the move up overnight was quite pronounced. In an equity market that continues to remain under pressure, A50 futures down about 1%. That's contract in Singapore. And as you look ahead to the open, 1% or so losses across these major benchmarks. Lots of corporate stories I'm going to tell you about. There's Wuxi, there's MGM China, there's CK Hutch, and there's also this Bloomberg scoop on Standard Chartered, perhaps looking at maybe some of the changes there as far as corporate investment banking units are concerned. Welcome to the program, by the way. Here's the open for you. Yeah, there we go. 1% drop across some of the major benchmarks here in Hong Kong. Mainland markets are still shut, so keep that in mind, right? So MSCI China, part of that trades onshore, at least some of the constituents. Some are here. Don't expect volumes to come through because you don't have the stock connects today. All that being said, all you need is a hot print to get a price action of that sort. 230 points to the downside here as far as the Hang Seng Index is concerned. Okay, let's talk about your corporate stories, and let's flip the page while I go through my notes here and try and pick out the top stories here. Okay, so Stan Chart, not much reaction there, and the story is certainly the bank mulling breaking up its corporate and investment banking unit. Certainly one of the top red stories on your Bloomberg today. You can read about that on the terminal. Wuxi Biologics and Wuxi AppTech. Some U.S. lawmakers are looking at maybe a formal, so I understand, a formal probe into the company. I could be mistaken here in terms of the phrasing, but okay. But the company's reiterating it does not pose any national security risk, and the company fully supports regulatory reviews while it strongly opposes any inaccurate statements and also unfounded allegations. MGM, that's an earnings story, full year revenue beating estimates, and also Chung Kong Holdings, and the story there is maybe they're putting this deal on ice as far as the Italian assets are concerned. Some Italian assets are concerned. Okay, let us pivot away and have a look at what's underneath the hood here. HSI, MOV on your terminals gives you a sense of breadth at the open with the price declines of about now closing in at 300 points. Session lows in that, and as you can see, just about every single stock, with the exception of one. Okay, well, live pricing right now, so every single stock is down at the open. Let's talk about the story right now as it pertains to MSCI and the changes there. So while the index compiler is cutting dozens of Chinese companies from its global benchmark, it follows a market route that's erased, a couple of $1 trillion off the market value of the nation's stocks. Greater China, of course. Let's bring in our Asia equities reporter, Charlotte Yang, is with us here to talk us through the changes here. So what the key takeaways here for you?
Yeah, so Index Compiler announcing their February review that they're going to cut 66 companies from the MSCI China Index while adding 5. And among those deletions, you have like real estate developers such as Jimdo. Yep. You also have healthcare companies like Ping An Healthcare, and also aviation like China Southern. So investors were definitely closely watching these single stocks. I mean, the change will happen later this month, but when that happens, you will have this pressure on the fund flow, which you have at least $5.9 billion passive funds tracking this index. So we might see some investors cutting those stocks before that happens. And we also have 3 stocks from the Hang Seng, so MSCI Hong Kong Index will be removed. That includes like New World Development as well as Budweiser. So this could be placing more selling pressure for that today. Yeah,
we're flashing some of the initial moves and quite pronounced. So correct. I mean, we are seeing markets caught off guard by this. There were some additions, though, to some of the indexes as well. So it wasn't just a net removal of, it wasn't a gross removal.
Yes, it wasn't. So we are seeing like 5 stocks being added to the MSCI China index, and that includes some of the biotech names. So it is not just a net change, but there are also some investors' concerns about China's heavy weighting in the MSCI China Gorges. While we do not know the specific reasons behind a single stock changes, but investors have been worrying about that for a while.
Yep, there we go. Something else to worry about. Charlotte Yang, our Asia equities reporter. As you can see, some declines across the board here, and so you have the sort of the broader headwinds on macro, plus you have the micro story on MSCI. I think these are live pictures. There we go. Boom. Okay. As we welcome, hopefully, a change of trajectory for the markets. The year of the dragon has started officially as far as markets go. 1.6% to the downside. Joining us here on set out of Goldman Sachs, Su Fu, China portfolio strategist there with the bank. Nice to see you. Happy New Year.
Nice to meet you.
I want to unpack this report that you guys put out, because certainly the market's trying to figure out if this equity market has found a floor. And the question you guys pose is can the potential stabilization fund rescue China equity in 2024? Before we look at the actual answer to the question, how do you guys define rescue? What does that mean?
Yeah. When we talk about national team rescue, mainly we are referring to they can stabilize the market, that is, it stop declining. And more in the short term, we look at the next 3 months market performance. After the national team buying, the return can turn positive. That is how we define rescue.
Okay, and so far, what do you make of the price action? This is only 2-3 weeks old anyway, since reports started coming up. And what do you make? What's the sense you get of? Is a bottom in? Are we still trying to find the bottom?
Yeah, so far we see the national team have been quite active compared to historical periods.
Yep.
So in the past 1 month before the Lunar New Year holidays, the national team have net bought the ETFs by around 140 billion RMB. This is a meaningful amount compared to historical experience. Only a few quarters was larger than that.
Yep.
In 2015, that was even larger, that the net buying was exceeding 1 trillion RMB. So based on the historical experience, how much will be enough to rescue the market? We estimate that the net buying, if it exceeds 0.8% of the free flow market cap, equivalent to around 200 billion RMB, that could be the minimum amount to stabilize the market, as I said, in the next 3 months.
Okay, and is that the timetable? Is it 3 months that they need to remain in this market? In other words, how long does the program need to last?
Yeah, historically they stop when they feel the market really stabilized, stop declining even without their buying.
Right.
So the time frame really depends on how much selling pressure the market has. It could last for 1 quarter or even 2.
Okay, yeah, because I think in 2015, once they stopped buying, the market continued to move lower as well.
Right,
but
then they come back again.
Okay.
So the buying lasts for 2 quarters in 2015.
Right, now from a tactical perspective for investors, I think isn't the philosophy is you buy what they buy. So tactically, what will be the sort of rational longs at this point in time?
Yeah. Currently, I think first the national team step in, which kind of provide some downside support that kind of gives some confidence to the investor. So giving the additional selling pressure is getting smaller. So that's in the short term why we think we need a national team. But in the longer term, we definitely think there still need more comprehensive easing package to address the macro problems. That will finally turn the market up.
Right. So do you think we should get our expectations up? Because the NPC is coming up in about a month, right? And ideally those, I think, where we get some of the measures that would address some of the structural issues as well. What are your expectations going into Liang Hui? Two meetings,
First, the market consensus is they will set the GDP target at around 5%.
Yep.
That is similar to our economists' forecast. We forecast 4.8%. That means on both fiscal and monetary policy, they need to remain quite supportive. That is also our expectation. Our economists still expect 2 interest rate cut and 2 RR cut in the rest of this year, and also for the augmented cumulative fiscal deficit we expect is to be a little bit larger than last year. So that will continue to provide support to the market. But what we think from the investor perspective, what is wish to have is a more comprehensive plan or long-term plan to address the property local government debt issue. The expectation is low, but if it could come, that will be a meaningful change to the market. Besides that, if there could be any policy from the demand side or direct stimulus on consumption, that will be also welcomed by the investors.
Right. There seems to be, I think you hit the nail on the head, there seems to be a gap between what the economy needs and to hit 5% growth, for example, and what the market wants.
Yeah.
Right? And while we try and figure out what that gap is and how to trade it, what do you think is the ideal equity exposure to China right now?
What we think is first, the national team buying is a more near-term thing that create direct demand for the equities. So the national team favorite stocks, including some high-quality SOEs, large index constituents, these may benefit directly from the flows. That is in the near term what we like. And besides that, many of the stocks have strong cash return to the investors through dividend payment and also buybacks. So these are the things we like in the near term. But looking into the longer term, the key theme we like is we call the China rebalancing portfolio, which including stocks about mass consumption, technology development, going global theme that the Chinese company gain market share in the global markets. We combine all these themes together and screen out our buy-rated stocks, which is high-quality names. That is what we still like in the long term. So in the long term, we think the growth driver will continue to be technology. So we like the soft and hard technology.
Yeah, I spent a lot of time reading the reports, and I'm curious when you look at when you mentioned screening, for example, and we've been talking about here on the show how everything is cheap in this market. Simple question, I guess. Do valuations matter? How do valuations go into your screening process when everything is cheap?
Valuation is definitely important. A low valuation is a necessary condition, but a low valuation is not good enough. We still need something more. So when we screen for high-quality stocks, we also look at their ROE, look at their growth potential. Especially we look at their R&D investment because that guarantees their long-term growth potential. So even for SOE companies, we screen them based on these measures, taking them into consideration together with the valuation. So we need the company to have low valuation. At the same time, we hope them to have earnings delivered.
Okay, and what's your outlook for earnings this year?
Our earnings forecast for the whole market is 9% for this year.
Okay.
And next year also around 10% earnings growth.
So this is MSCI China?
MSCI China, and similar for CSI 300.
Okay, just final question for you, since we started off this conversation looking at the stabilization fund. Where's China going to get the money?
Yeah, we see a few different channels they can get the money. So a short answer is the sources are abandoned. First thing is we have looked at our SOEs, the non-financial SOEs listed in A and H market. They have 10 trillion RMB cash or cash equivalent on their balance sheet. So this is potential source. The other thing is we look at the pensions, insurers. They have around $4 trillion AUM under their control and only allocate around 12% in equities right now. They can definitely raise the allocation in equity. There's another channel. The final channel is if the scenario is really worse, then definitely central bank can expand their balance sheet to support.
It was great to speak with you. Let's do this again. Happy New Year. Sifu there, China portfolio strategist at Goldman Sachs. We'll take you straight now back to the Hong Kong Exchange, where I've been told, there we go, there is the usual greeting that gets us into, and fittingly as well, the Year of the Dragon. We'll leave you with a live shot and maybe a little bit of sound from what's going on there. This is Bloomberg. And a selfie. There we go. Get that on the gram. Okay, so things are looking good. I'm not being sarcastic. We're coming off lows of the day, so we were down as much as 1-2%, near 300 points at the downside on the Hang Seng Index. We're coming off those lows a little bit. I think we're also digesting some of the news out of MSCI, so certainly in terms of price action, more pronounced on those names that were removed, will be removed effective end of the month here from global benchmarks. Developers down about 2.1%. Let's get to this other top story in China. China is lashing out at this new proposal from the EU to possibly sanction about 24 firms, including 3 from China, accused of aiding Russia's war in Ukraine. For more on the story, let's bring in Stephen Engel, our Chief North Asia Correspondent, on what we know so far. And China's fairly upset with this.
Yeah, I mean, this is to be expected. The Ministry of Foreign Affairs putting out a statement saying that they firmly oppose these proposed sanctions from the EU. Keep in mind, last year, China was faced with a similar type of possible sanctions on its firms, but they were able to kind of assuage the fears of some of the EU bloc members, and they decided to drop that, but this has been sort of revived. This is what China is saying. We firmly oppose illegal sanctions or long-armed jurisdiction against China on the grounds of cooperation between China and Russia. They go on to say China and Russia enterprises carry out normal exchanges and cooperation and do not target third parties, nor should they be interfered with or influenced by third parties. Okay, so this is the issue that the EU has said, as well as the United States separately, that some companies could potentially use third nations or third parties to evade or get around some of the sanctions on products going into Russia that could potentially aid its war in Ukraine. So again, we'll have to see whether this goes forward and actually is imposed, but it is another salvo in what has been, let's face it, a bit of a deteriorating relationship between China and the EU at a time when Beijing has clearly stated it wants better relations with the EU. You have obviously the fight over EVs, electric vehicles, the European Union looking at sanctions on EV makers, perhaps because of illegal subsidies and the like. And then China also has talked about subsidy or sanctions on EU liquor imports into China. There's a whole issue with high-end chip making equipment from ASML and them going along with U.S. sanctions on the export of those, machinery to China. So again, this is another stumbling block in what has been a bit of a fraught relationship right now.
Well, speaking of, but separately, we're also hearing news that a senior U.S. House delegation is headed to Taiwan next week. How might Beijing respond? What do we know also about that?
Yeah, I mean, U.S. congressional visits to Taiwan are not unusual, right? So they happen all the time. Why this is what is interesting is because it comes shortly after, of course, the election of Lai Ching-te, and he gets inaugurated on May 20th. We're hearing from the FT that essentially Mike Gallagher, he is the head of the House Subcommittee on China Relations. He is a known hawk, and he is a strong supporter of Taiwan issues. We also know that he is not going to be running for re-election in November. So the parallels of this one could be drawn to Nancy Pelosi, who was also on her way out and went to Taiwan, sort of her swan song as well. Whether that's going to be Mike Gallagher's agenda, we don't know. But according to the FT, he's going to meet with Lai Ching-te. He's going to also meet with the new incoming legislative speaker, Huang Kuo-yu, who's from the KMT, the other party, not the DPP. So anyway, it'll be very interesting times at a time when, of course, the U.S. Senate has approved this $95 billion aid package to Ukraine, to Israel and Taiwan, which possibly could hit a stumbling block in the GOP-dominated House.
Steve, thank you so much. Stephen Engel, our Chief North Asia Correspondent. Now, over in Europe, and certainly one stock that really moved quite substantially was Michelin. So shares 7% in the European session there. Most, in fact, by a year there. The tire maker announced this buyback program worth more than $1 billion. And the CFO, Yves Chabot, actually told us about the business outlook and underscored also many of those points. Have a look.
There is still a lot of uncertainties about the growth in China. U.S. market has been very resilient in 2033, but there is still some question mark from 2024. So that's why we have built a guidance which is based on our best knowledge of the situation at the moment. knowing that we are in a business with some cyclicality within the year, generally very strong Q2 and Q3 momentum, and it's always extremely difficult in January or February to predict with a very high level of certainty what's going to happen. But we are positive.
Okay, so
as you said, we have. Yeah, we have announced.
No, I was just going to ask because you touched, Yves, you touched on your caution about China, and you talk about the US market. So I wanted to think about, or at least if you can tie that view into how you're seeing the demand outlook for the tyres part of the business as we look to the quarters ahead, Yves.
Yeah, we have the market. We believe that the market will more or less be flat. If we take into account both original equipment and replacement. Don't forget that Michelin is exposed to the OE part, the original equipment part of the market for passenger car vehicle at only 10% of our global sales. And we are seeing probably contrasted evolution between original equipment, which was very strong in 2023, and replacement that was weaker because of massive destocking in distribution. We think that 2024 should be more balanced between these two markets.
There we go, Michelin CFO with our Tom McKenzie. Right, there's plenty more ahead. This is Bloomberg. So beginning, well, as of the close on Feb 29, oh, that's interesting. Do we have a Feb 29 this year? Okay. So, well, effectively from the start of March, we will not have these stocks in the global benchmarks for MSCI, among others, of course, that the index compiler removed. And as you can see, markets are reacting to that news. And we have a whole story of that, of course, on your Bloomberg terminal on the website. MSCI cutting a whole swath here of Chinese stocks from their benchmarks there. Okay, that's one group of movers today. We're also looking at casino stocks. And Citi was out with an interesting note this morning, and the bank is saying that the Citi saw a strong start to the Chinese New Year holiday week. Mainland visitors rising 34% in the first 3 days. If you compare that to the same 3 days back in 2019, MJ in China incrementally higher as well on the back of earnings coming through as well, with revenue beating estimates. We'll leave you with a look at the benchmark here in the Asia Pacific, where I think in many ways we're still also feeling the macro headwinds of a hotter than expected US CPI print, a stronger dollar, yields moving higher. And as you can see on your screens, every single major sector here in the equity complex is down today. Down about 1% in price. S&P futures are flat, and the Bloomberg Dollar Index, while pulling back a little bit, saw one of the biggest jumps on this specific benchmark in several weeks. We'll talk more about dollar-yen on the other side of this break. Lots of commentary coming out of Tokyo. This is Bloomberg.